Okay, so in this video, I do want to speak about exactly what we all need to know about taxes for 2026. Now, I understand that for the majority of the people here, they're very new in regards to learning about taxes. So I'm going to be explaining how the whole timeline does work, and then we're going to get into the specifics and what we must know. So to make things very clear, the tax year is the year you earned the money. For example, the money that you earned between January through December 2025 is your 2025 tax year income. Your filing year is the year you submit the return. So you typically file your 2025 taxes in early 2026, usually between March and April. So when we speak about 2026 taxes, we're talking about filing your 2025 return. And so the IRS announced many changes for the tax year of 2026. And here's going to be everything that has been changing and how it does impact your paycheck. Let's start with standard deductions first. It states here that in 2025, the standard deduction for a single taxpayer is $15,750. It would be $31,500 for a married filing jointly. In 2026, though, the standard deduction is increasing by $350, which is $16,100, and then $32,200 for married filing jointly. Now, for those of you guys who do not know what a standard deduction is, the government is basically saying we won't tax the first chunk of your income. So the IRS 2026 inflation adjusted standard deduction for single filers is $16,100. So for example, let's say somebody makes $40,000 for the year of 2025. Does that first $16,100 get taxed? Yes or no? And no, it does not. Because remember, that first chunk of $16,100 will not get taxed from that $40K that you have made in 2025. It's shielded. What will be taxed though is the remaining amount outside of the $16,100, which is going to be $23,900. That is what's going to be taxed, not the $40,000 that you have made in 2025. So remember, a higher standard deduction is usually good if you take the standard deduction, because most people do that. So now let's talk about tax brackets. We do have a new set of tax brackets, but let's compare 2025 and 2026. In 2025, the tax brackets were the following, as you can see on the left side. For example, we see 10% for the incomes of $11,925 or less. It goes to 12% for incomes over $11,925. It goes to 22% for incomes of over $48,475. And then we look at 2026. It has gotten a little higher to combat the inflation. We now have 10% for incomes of $12,400 or less, and then we have 12% for incomes for over $12,400. Then we have 22% for incomes over $50,400. On the right side of these numbers, you can see that all of this is just the married filing jointly. So as we can see, everything has been upped just a little. So everybody here does get a little more breathing room before they get into the next tax bracket. Now, for clarification, tax brackets are marginal. That means only the money inside each bracket slice gets taxed at that bracket's rate. So here's going to be a real world mini example to make things very easy to understand. Let's just say that you're single in 2026 and you earn $40,000 from the year of 2025. The taxable income is going to be $23,900. And that $23,900 does get split based off these brackets that we have just talked about. 10% will be headed towards the $12,400, because remember, the brackets exist. There's different brackets for 2026. And then a 12% tax will go to the remaining $11,500. So your income tax is roughly going to be around this. You have to pay $1,240 for the $12,400 and $1,380 for the $11,500. And in total, you have to pay $2,620 in taxes. So now let's talk about the capital gains tax. It states here that in 2025, you pay 0% of capital gains tax if your taxable income is $48,350. In 2026, the 0% capital gains tax will apply if your taxable income is $49,450. Here's going to be the key idea. Capital gains does mean that you have made profit from selling a investment, whether that is a crypto, a stock, or whatever. Now, here's the thing. Two timelines do matter here. Let's say you make a short-term gain in the year of 2025, like it's held within a year or less. Like you bought something for $30, you sold it for $60 2 months later. That's going to be taxed as regular income. However, let's say that you have made long-term gains that is withheld more than a year. You do get special rates of 0%, maybe 15%, maybe 20%. And let's say that you decided to sell a stock after holding it for like 5 to 6 years, and you decided to sell it in the year of 2025. Whatever profit margin that is, let's just say for example it's 5K, you have to add that 5K to the 40K, going back to the original example, that you have made in 2025. 2025. That basically means that you have made $45,000 in that year, and that's going to be gross. And so because you are under that threshold that we talked about in terms of the capital gains, where you get a 0% capital gain tax, you will not get taxed off of that long-term gain because you're under the $49,450. If you went over and you made, let's just say, $10,000 in terms of profit for the year of 2025 when you sold that stock, that means you go over the $49,450. Then the tax will be applied, and all you have to do is just pay your taxes for the $40,000 that you have earned in that year, not in the $5,000. Let's move on towards the next one, and that is earned income tax credit. It states here that in 2025, the maximum earned income tax credit for 3 or more children is $8,046. In the tax year of 2026, the maximum earned income tax credit amounts to $8,231. What this basically is it is a refundable tax credit aimed at low to moderate income workers, especially with kids. And this one's very simple. Like the way that this looks is you're not going to get like the full AK all at once, like let's just say a random check in January. That's not going to happen. You claim it in your own tax return. It usually shows up inside your refund, or it does reduce what you owe. So it's not really treated as a taxable income on your federal return. So for example, let's just say someone qualifies for $6,000 for the earned income tax credit and you owe $1,200 in federal income tax. You can use that $6,000 that you have qualified for to wipe out that $1,200 and you owe zero, and the remaining balance is going to come back to you of $4,800. It's a refund. Now let's move on towards the next one, which is the 401k limits. And it states here that in 2025, the 401k, 403b, and 457 limit is $23,500. In 2026, the limit has increased yet again by $1,000, which amounts to $24,500. And in addition, the total annual amount you can contribute to a 401k or 403b is planned to increase to $72,000 in 2026, which originally was $70,000 in 2025. So this could include things like your typical own contributions, employer's match, and the mega backdoor contributions. So remember, you have a limit, and the max you can use for 2026 will be $24,500. What you can get in total for 2026 will be $72,000, because if you combine employer match and other options, you can get to that point. But you yourself cannot put in $72,000 for the year of 2026. So the way that employer match does work is, let's just say that you contribute $100 for the month. The employer match can do 50% of that, which is $50. And in total, you get $150 into that account. Let's move on towards Roth IRA and its limits. In 2025, the maximum income limit to contribute to Roth IRA directly is $165,000. In 2026, the income is increasing to $168,000 and $252,000 for married filing jointly. The limit in terms of annual contributions to a IRA was $7,000 in 2025, but now it is $7,500 for the tax year 2026, so an increase of $500 total. If you are over the age of 50 years old, it is going to be increasing by $1,100, not $500. If you guys were wondering what is the difference between a Roth and a 401k, to put it very simply, like Roth basically means you're going to be taxed now. You're not going to be taxed later like what a 401k does. However, when you withdraw in retirement with your Roth, it's going to be tax free. So it's like the reverse of what the 401k is. Then we do have annual gifts, and the max that you can do on the annual gifts is going to be $19,000. It has not changed. It is basically the exact same thing. And what this is like if you give person A $19,000 and person B $19,000 as a gift for like whatever, it could be like a car or a watch or like straight cash, you can do that in 2026 without gift tax reporting for those gifts in general. Then we do have the HSA limits, which is the health savings account. In 2025, the contribution limits were $4,300 for a self-only coverage and $8,550 for a family coverage. In 2026, it's now increasing to $4,400 for self and $8,750 for family. HSA is a medical savings account, and you can use it if you have a qualifying high deductible health plan. There's a lot of tax advantages here. Like for example, if you put $4K into this account and you make $50K a year, all you have to do is pay taxes on the remaining $46,000, not on the $50K anymore, because once again, you have letting go of $4K into your health savings account. And this money that you leave in this account, it could grow, but it ultimately does depend on what you invest in. But there is no real guaranteed rate here. But I do think that the health savings account is a little weaker in California, because generally in California, taxes are executed on your earnings, on whatever you have on the health savings account. I don't know outside of California, but in California, generally they do that. And then lastly, let's talk about the estate tax. For 2026, the estate tax exemption is increasing to $15 million from the $13.99 million. So what that basically means is if somebody dies in 2026 and you know that person and you inherit whatever that person had in that year, the federal estate system generally exempts up to $15 million per person. So let's say there's a scenario where you inherit an estate worth of $14 million. The federal estate tax is going to be likely zero because it is below the exemption. But that does not mean you never pay tax on anything related to it. Because for example, let's say that you own whatever that estate is. What if you have a plan to rent it out and you rent it out at $4,000 a month? Whatever income you do generate from that estate, you're going to have to pay taxes on that. But you don't have to pay taxes on how much that estate was originally worth, as long as it is under $15 million. But that is it, right? Like, the general understanding here is that we have a little more breathing room on how much we do make before we hit either the next tax bracket. We have better and higher standard deductions. We have the estate tax and more breathing room. And so it's looking good so far. And hopefully you did learn something here and some brand new information that you did not know about. And that is it. That is going to be wrapping up today's video. Thank you guys so much for watching, and I will see you guys in the next one.